Okay, so economic growth has slowed recently in the UK and the US. There's also concerns about increased market power, growing market concentration, the falling labour share and income. How does your research explain what could have caused these trends?
Well, I would say number one is that not necessarily just my research, but other people's research makes me think that the amount of effort that goes into research is a critical contributor to growth. So by research, I mean innovation effort, some of which counts as R&D, some of which never gets counted as R&D. Like some of the sectors that have slowed down are not just sectors that are intensive in R&D and patenting as we measure, but even sectors like service sector that are retail that where not much formal R&D and patenting is done. So I think, and those are also some of the ones where concentration is increased and labor share has fallen, even outside of manufacturing. So part of it is saying research effort is not necessarily confined to formal R&D, can be more broad, and that may have fallen outside manufacturing as well as inside manufacturing. So one big contributor I would imagine is that population growth positively contributes to research effort, both on the supply side and on the demand side. On the supply side, more population growth means more people to put effort into innovation, into coming up with new ways to sell products and new retail models and more people to do research and come up with ideas as doctors or bankers or whatever profession. And then also the second side is this demand. So that's the supply, but the demand, meaning the more rapid the population growth, the more the size of the market for innovations in terms of if you come up with a successful, say, retail store chain, you can sell to more people and your market's growing. So when it slows down, it naturally means there'll be fewer people to supply innovations, or lower growth in people to supply innovations, and less demand for the results of innovations. So both of those would contribute to slower growth. So it's like saying even though population growth has a congestion component that's negative, it also has this really positive innovation component. So I think we're getting less of that because population growth has slowed, and that's happened in the US and the UK and other places. So I think that's one of the contributors to the slower growth. But there are other parts to your question, but we can talk about them sequentially if you want and come back to them. But that's just one thing I'll offer.
Okay, so population growth slowing has potentially led to the slowdown in economic growth. But at the same time, in the last 20, 30 years, we've also had lots of technological progress. And if you think about ICT revolution, and we've also had a rapid rise in globalization. Have those trends not counteracted the slowdown in population growth? Have they not led to a rise in economic growth?
Well, I mean, there was a burst of growth related to ICT, information and communication technology, that I think did push back against this secular trend of slower population growth and maybe slower economic growth as a byproduct. And so we saw a burst of growth, and it was partly industries that produce ICT, so computer and software, and then it was later industries that use ICT. So one of the big areas was retail and wholesale, seem to have effectively used information technology to improve logistics and provide lower cost services, lower cost products, and a wide variety of products in more locations. So things like Walmart or Amazon have increased the variety available to consumers, and creatively destroyed a lot of smaller retailers in the process. But that seems to be one example where we've generated a bunch of growth that goes against the demographic trends. Exactly.
So do you expect these trends to continue on in the future as well? Do you see that population growth continuing to slow down is going to continue to lead to a slowdown in economic growth? Or do you think there are other possible factors that could lead to a pickup in growth again?
I think the population growth is going to probably stay low, so I'm not expecting that to bounce back. So that will be a drag. Then the question is, can we have another burst of something like ICT? And the candidate that people are talking about, partly with anxiety and partly with anticipation, is robots and artificial intelligence. That people are finding a lot more uses for it. It still feels like something that it's more being discussed than we've actually realized the benefits of. As I say that, factories have become increasingly automated for not just in the last 20 years, but if you think of 100 years, you think of machines continually replacing tasks that workers used to do, or for farming for that matter. So in some broad historical sense, we've had automation for a long time, and that's been helping carry growth. So equipment, embodied technological change may be the main engine of growth. But people who are experts who know more about it than I anticipate lots of tasks. One concrete example would be using optical recognition to diagnose or to read scans that radiologists would normally read, and maybe read them more accurately than the typical radiologist would do, or for that matter, look at pictures of skin lesions and be able to probabilistically detect better than the average trained dermatologist whether it's likely to be cancerous and which types. So those are examples where it's not quite there yet, but the technology that our people are claiming that's going to be within 5-10 years. We're going to have driverless trucks. We're going to have all kinds of medical imaging that's going to be done by artificial intelligence. So a lot of the experts are telling us it's right on the horizon. So that gives me some optimism that we could get a burst of growth from that. And of course, at the same time, I can say optimism, it's not going to be good news for radiologists, it's not going to be good news for truck drivers, so there's going to be a lot of disruption associated with that. But that's true of other technological revolutions, like the Walmart expanding at the expense, or Amazon expanding at the expense of a lot of brick and mortar retailers. So that's the unfortunate side effect of globalization, technological change, is that there's a lot of disruption and a lot of job loss and permanent wage losses for sections of workers, millions of workers, and that's painful. And so then we have to think about how to make sure, maybe this is getting into a separate topic, how to make sure enough people benefit that we don't try to block those technologies, instead embrace them and spread the benefits rather than block them altogether.
Okay, so you've already touched on this a little bit, but kind of what are the wider implications of these macro trends? Like, who are the winners, who are the losers, and do you expect those to be the same groups moving forwards?
So I guess much better looking at past than predicting the future. So let me say, so far it seems to have been increased, inequality. So I'm heavily influenced by papers by David Autor, but also John Van Reenen. So it looks like you've got increasing firm concentration, so the most efficient firms, largest firms have benefited the most. Interestingly, they've increased their market share. So they've increased their, for example, Walmart increasing their geographic scope, or Amazon increasing the types of products it sells, and now it's in cloud computing and storage in a big way. So it seems to have helped the big players become even bigger. But interestingly, it hasn't actually increased their own profit rate. So their own profit rate is actually down a little bit. So it's helped them mostly by increasing their market share. And that means the smaller firms have suffered, and the smaller firms have also become less profitable, the profit rate at smaller firms. So there's been a drop in the profit rate within firms, but a shift of market share toward the highest profit firms. And so that's what's the main contributor to a decline in the share of income going to labor. Firms are getting a higher share of income, so the overall profit rate is up. But if you look at where it's coming from, it's because the high profit share firms are a bigger share of the economy. So like Apple has always had a really high profit rate, but they're much bigger than they used to be. So it's not that Apple's profit rate has increased, it's that its market share of high profit rate firms like Apple has increased. So in that sense, on the firm side, the rich have gotten richer in the sense of getting a bigger share of the pie, not necessarily their profit rate, but so total profit share of the pie has increased, workers' share of the pie has decreased. And then within workers, you see this wage polarization, meaning that the workers at the top have done quite well, workers at the bottom haven't done as well, but have done okay, and then the ones in the middle, there's been a huge hollowing out of jobs. So a lot of middle skilled jobs have either been replaced by automation, or like bank tellers, or a lot of middle management jobs, or outsourcing. So there's a lot of loss of these, in Autor's language, these cognitive routine jobs as well as non-cognitive routine jobs have been heavily either automated, like in manufacturing, or offshored in some white-collar areas. So I think that means very uneven benefits. And the people at the top seem to have benefited the most. the highest skilled, and it's like this fractal. The higher you go in terms of the fraction, the bigger the benefits. So the top 1/10 of 1% has benefited the most, and the top 1% has benefited more than the bottom 99%, and so on. So you see, it seems to have really helped. It's almost like a tournament where the highest able have been able to take advantage of their skills and spread them. So ICT may be the fundamental explanation of that, because information technology may enable somebody with a very rare skill to now have influence over a much bigger market than they used to before. So, the extreme example of that in history would be like a really good actor or actress used to be able to just do a local play, then they could become a movie star because of technology. So it could be a version of that is operating in all industries or most industries, and even on a global scale, so that the really unusual talent in the far right tail is capturing a much bigger share of the pie than it used to. So that would be, so the rising inequality, the gains aren't being spread equally, a bunch of groups actually losing. By bunch of groups meaning millions of people. I mean, in the US, 7 million less manufacturing jobs, they're probably not coming back because part of that's due to trade, but a bulk of it might be due to automation. So we might have factorless, not workerless factories, but much less labor-intensive factories. Even if we built a bigger manufacturing share as a share of the economy in places like the U.S. and UK, we don't expect that to be very labor-intensive.
So I guess along with the kind of IT revolution, there's also been like a rise in globalization. And we've certainly heard a lot with political rhetoric in the last few years and a backlash against globalization. And we've seen kind of with that also voters now voting for Brexit or for Trump. Going back to this idea that like workers have lost their jobs, are there ways that policymakers can help those workers to reallocate into other professions? How do you see policymakers helping workers in that sense?
So the workers know that they haven't benefited, right? So, the ones who've kept their jobs, the wages haven't kept pace in many occupations for millions of workers, and then there's a bunch that have displaced and are working in other sectors at lower wages, and that's very well documented. But it's like that's the reality that those people were experiencing. They didn't need any economist to tell them it was happening. So they knew individually, but then economists were able to document, yes, this is a phenomenon that's affecting millions and millions of people. So I think, as you mentioned, that affects understandably how people vote and how they view free trade, how they view globalization, how they even view technology. I was kind of surprised that my casual, sociology or psychology was that there's a lot more hostility toward free trade than losing jobs to imports than to losing jobs to robots, or for that matter to e-commerce in the case of retail. But there has seemed to be a growing hostility toward companies like Amazon that are disrupting traditional brick and mortar retail. So that's the more of the diagnosis. Then the question is, what should you do about it? So one thing that people have talked about is universal basic income. I'm not. I like the idea in principle, and I'd love to use like carbon taxes plus a carbon dividend. That's basically a form of a universal basic income. Everybody would get the dividend, and that's a nice thing because at the same time we're helping to solve a market failure in terms of excess pollution, or in terms of pollution, the price of which polluters aren't paying for the damage they're doing to the environment. So that has like a win-win property to it. On its own, a carbon tax would be regressive, meaning the poor pay a disproportionate share of their income on electricity and gasoline, but by creating a dividend that's per capita equal, you turn it into a progressive thing, because the rich do spend more in absolute terms on energy. So framed that way, I like that policy, and I can imagine trying to extend that with, if there's other bads we can tax, that would be ideal. So taxing things like pollution and in other forms, but also if there are things that are inelastic like land, I would like to tax income from land. In the US, the typical property tax statement breaks down the component of the value of your property that's due to the structure versus land. Land is inelastically supplied. It's a classic Henry George idea that we want to tax things that are inelastic because then you won't distort their supply. So I think we could generate some more revenue through a land tax. And so we could use things like carbon taxes and land taxes to finance, a demogrant that was basically universal basic income. But I don't want to push too much that because it starts to feel like, disability, which I don't think is a great life in the sense of like disability in the U.S. is like $13,000 a year plus medical insurance. That's not horrible, but it's not the same as having a $40,000 a year job, and so I think there's a lot more political support. I guess it's a little dangerous, an economist judging what's politically appealing, but I think it's natural to consider an alternative, which is wage subsidies. So instead of basically paying people regardless of whether they work, supplementing their earnings if they do work. So a way to potentially benefit millions of workers to try to find gainful employment despite the automation that's happening is to subsidize wages that they do earn, so that up through a certain level the government would match their wages, and then that would phase out eventually. That's the disadvantage. During the phase out range, there's a positive marginal tax rate or an increase in the marginal tax rate that could distort behavior, but there's distortion in universal basic income too, because that's going to be financed somehow by either carbon taxes or land taxes, and not all of it, depending on how generous it could be financed by that. To the extent that we've used income taxes, that's like creating a distortion as well. So anyway, the short answer is wage subsidies is something I'm very sympathetic with exploring and trying as a way to spread out the benefits of things like automation. Hopefully we'll get a burst of average productivity growth and aggregate growth out of artificial intelligence and automation. And then I'd like to try to use wage subsidies to spread those benefits out as far as possible.
So one of the advantages of universal basic income is that it benefits everybody. Obviously, the other side of individuals being workers is individuals are also consumers. And do you think that these kind of macro trends through the ICT revolution, globalization, and also the growth of these large firms, has that benefited consumers, or are firms starting to exploit consumers as well?
Well, the fact that labor share is down and the aggregate profit share is up is suggestive that the average markup might be up. The firms are charging a higher markup because, again, the market share of what I was calling the high profit firms, those are the high markup firms. So in that sense, consumers aren't benefiting as much from the shift toward these more productive firms as they would if these firms didn't charge higher markups. So it ends up being this trade-off, which is that if the reason they've gained market share is that they've innovated and they've done something productive, there is a benefit from that. So for example, we're saving a lot of resources by not having as much brick and mortar retail. That's resources we could reallocate to other uses. So that's a gain. On the other hand, I'm not sure Walmart or Amazon actually has that high a markup yet. They're kind of interesting because they've been in market expansion mode for such a long time, and they only in the last year and a half started to actually report profits. But eventually so they might not be the best example of a high profit firm, but eventually it's clear that they have a lot of market power. They could start exploiting that. And maybe they are exploiting it with some of their suppliers, for example. So they might not be exploiting it yet as much on the consumer side, but they certainly are positioned to do that going forward, because it's not that easy for somebody to enter that market now. As we can see, another online marketplace hasn't really emerged. Walmart.com is struggling to really get kind of traction that just a very small share of Walmart sales come from online, for example. So I think the workers are getting a smaller share, firms are getting a higher share. That means that the owners of firms and the high-skilled managers, high-skilled executives of firms are getting a disproportionate amount of these gains. So I think it's expanded the pie. It's contributed to some of the growth that we've seen is the success of these big firms, but it hasn't been distributed that equally.
So should policymakers be concerned about these large firms and them gaining this dominant position and it being difficult for new entrants? And if policymakers should be concerned, should they intervene, and how could they do so?
So I wish I knew exactly the answers to those. I mean, those are like trillion-dollar questions, and so I'd love to, just like in health, there's many trillion-dollar questions you could ask that the doctors don't have the answers to yet. I don't have an answer to that. I would say uncertain. So I could certainly see some logic about why you would be really worried that their monopoly power should lead you to break them up. I think the difficulty is, there are big economies of scale that's enabled somebody like Walmart or somebody like Amazon to do so well. So I'm uncomfortable with breaking them up. I kind of want to somehow have the benefits of their efficiency without that. But yeah, I think there's, the entry rate of new firms is down. That could be tied to the success of these big firms. It's harder to imagine entering the online marketplace other than through supplying through Amazon. You can try to do it directly, but that's going to be, that's less powerful. Or, you can access a lot of consumers directly through going into on the Amazon marketplace. So I think there is this danger that firms are now that try to compete or face more competition from these big firms, and therefore the profitability of their innovation, and then maybe down. So the control of the markets by these large firms may be discouraging innovation. So there may be this tension. They got this dominant position by being efficient, and that was positive then, that they were so good at what they did that they achieved this position. So that was a positive. But now that they've achieved it, that may be holding back growth. So a mechanism would be, as you were hinting at, new entrants that try to come in, it's just going to be harder to break into that market because you've got a dominant player with low costs and a lot of infrastructure in place. So it's going to be harder to enter that market. So their return to their innovation is going to be lower. And then if you even think of the big player, there's at least a couple of ways in which the big player might be disincentivized by their dominant position. One is if they already have a bunch of the market, your investments to improve your efficiency can only go so far because you're already in a dominant position. You can't gain a lot of market share from innovating further. But the other thing is, imagine that what happens is they expand further by going into more markets, even more markets. So I'll give one example is, Netflix drove out Blockbuster, and Netflix has a dominant position, but then there's Hulu kind of chipping away. But now we have Amazon Video. Apple's going to come up with a streaming service. Disney's going to start its own streaming service. Warner Brothers is going to start a streaming service. So these very big players who are very dominant in different. Disney's movie success is unbelievable. So you got Star Wars, the Pixar, Marvel, and live action remakes of the classic. It's incredible. So they're in a dominant position in the movie industry. And then picture them moving into a natural complement, which is streaming. But when they do that, they're going to be running up against Netflix, Amazon, Apple. So you could have, even though these are examples of further innovation, what you could have is the big players are thinking, we want to enter more markets, but now we're going to run into each other. We're going to run into other efficient firms. And so that may cut into the profitability of further innovation. It might be healthier for ongoing innovation to have, instead of big players who block kind of entrants and kind of block each other, to have less prevalence of dominant firms. So again, to kind of recap, it feels like they've gotten a dominant position by being very efficient, and that's been good, but they may have now erected barriers to their own further innovation and innovation by smaller firms. That's the concern. But I don't know the answer if that's really true and how much that's true. That's why I'm not willing to say go break up some of these firms.
Yeah, I guess that the firms themselves are also stopping other firms from exploiting consumers too much, otherwise they're able to enter into those markets. Now we do have these big firms who are able to span multiple markets. Do you think there are any industries that maybe we should be more concerned about than others, or do you think that this is likely to be a trend across all industries?
Well, I think any industry with like a network effect, a strong network effect, so like social media, like Facebook, and even like the Amazon marketplace, those are particularly troublesome because you can just see how hard it would be to start a new network. So, and then a related thing, which I hadn't touched on previously, but like lots of people are interested in now, but one would be Chad Jones and Chris Tonetti. Laura Veldkamp is working on this, that if there are firms that collect data in the process, that's a big source of their advantage. So that could be in social media, but it could also be driverless cars. So Uber is collecting lots of data that might make it hard for an entrant to come in. An entrant who knew how to design the software, but didn't know all the data, didn't have all the data to to train their software on. So that could be a big advantage for an incumbent. So I think we have to think about, so some of Facebook's acquisitions are interesting that might have bought up competitors that would have that are part of competing networks. So that I can imagine a bunch of economists, were skeptical of that being a good thing. So I'd like to have competing networks to the extent possible. So I'm rooting for Lyft to compete with, to stay around and compete with Uber, and other entrants to come in. So I'm particularly, worried about where there's like a network externality. And so then the government could think about, I'm not an IO economist, so there's people who specialize in these industries who know much more about them than I do. But it seems to me that the governments could think about ways in which they could facilitate competition. In the case of Microsoft, it was saying you can't forcibly bundle, the Internet Explorer and not allow or make it difficult for people to use other web browsers. So that things like that, where you could somehow allow people to access, some of the networks, so to keep the networks somewhat open that are created by some of these big players. So that's something I think regulators have to think carefully about, because that could potentially allow more competition and prevent them from fully exploiting their network monopoly that they've created partly by being good, but now that they have it, they might, like I said, be a barrier to further innovation.
So you mentioned that these large firms buying up these startups when they're relatively small. We saw that with Facebook buying WhatsApp when they only had 40 employees for a multi-billion-dollar valuation. So I guess two things here. Does that change the incentives of these startups now that they know that they can get bought? And also, should we be concerned about how this might change incentives to innovate when people move from being in these relatively dynamic startups into these larger firms?
Yeah, I think it's great to ask the question of like, how does it affect their incentives? And there's like a benign, innocuous version of this, which says these big established players have this distribution network. Say in the pharmaceutical industry, you use different examples, but I'll use that one for some of the big established players. They know how to navigate the FDA. They know how to run trials and phase, all their phases. And that's a big infrastructure that they've spent billions accumulating expertise on. And then you have these innovative, companies that are coming up with new drugs. So that the one innocuous, benign version is this is great. They've done what they specialize in. Once they came up with a promising drug, then that can be bought out by the big player who can then get it through the regulatory process and distribute it and brand it and allow consumers to access. So that all sounds benign. So then I think the danger, I guess, is that if they're buying up companies to kind of suppress them, so if they're buying up potential competitors to block them, that's like, has different terminology in the patent space, but that would be a bigger concern if they're basically trying to prevent a competing network from arising. So, Instagram is an example of one that could have been a competing network, it seems like. So that made me a little uncomfortable, that acquisition. So, that's what I guess I'm more concerned about, is not the buying them up to then carry them to the next phase, but buying them up to block their innovation. So it could be healthy, is the first part, but it depends on how they're used.
Okay, fantastic. Well, thanks a lot, Pete. It's been a fascinating conversation, and I hope you enjoy the rest of your time in Cambridge.
Okay, thank you. Thanks for having me.